Global central banks have just delivered 316 rate cuts in a single cycle. Historically, this level of aggression only happens when the world is in a deep recession, moments like the 2020 lockdowns or the 2008 financial crisis. But today, the economy is still growing at 3% and the stock market is sitting at all-time highs. So either central banks are panicking about a crisis that we can't see yet, or they're about to fuel one of the biggest market melt-ups in history. To understand why central banks are easing today, we need to zoom in on the United States, because its central bank, the Federal Reserve, usually sets the policy tone for the rest of the world. And in the US, we might be seeing signs of strain. The unemployment rate has climbed to 4.6%, more than a full percentage point higher than in 2023. Historically, every time unemployment rises by this much, it's marked the early phase of a recession. In fact, rising unemployment is one of the key indicators the NBER uses when determining recessions. And this jump in unemployment is likely one of the main reasons the Federal Reserve started cutting rates even before a recession officially appeared. At first glance, that looks like good policy, cutting early to prevent a deeper slowdown. And if unemployment stabilizes from here, this could be the beginning of something called soft landing. But history shows that early rate cuts don't automatically prevent recessions. In 2008, the unemployment rate also rose by about 1%, just like today, and the Fed responded quickly with aggressive cuts. But job losses kept accelerating anyway. Unemployment eventually hit 10%, and the economy fell into a deep recession. The same thing happened in 2001 and 1990. The Fed cut rates rapidly as growth slowed, yet unemployment continued climbing and the recession unfolded regardless. Rate cuts cannot reverse an economic downturn instantly. They take time, and sometimes they arrive too late to prevent what's already underway. And it's possible that today's situation may be no different, but not all employment data is telling the same story. Initial jobless claims, for example, are currently sitting near some of the lowest levels in more than 30 years. While the unemployment rate tells us how many people are already out of work, jobless claims show how many people are actually being laid off right now. So this divergence means that companies aren't firing workers, they're simply not hiring new ones, causing more people competing for fewer positions. This looks very different from the periods leading up to recessions that we've mentioned. In 2008, 2001, and 1990, jobless claims surged first before the unemployment rate spiked. Layoffs were the early warning, but today, that early warning hasn't appeared. One thing that could explain this is credit conditions. This chart shows the percentage of banks tightening their lending standards. When the line is above zero, credit becomes harder to get, businesses face higher borrowing costs, growth slows, and layoffs often follow. And again, we can see this clearly before past recessions. But when the line drops below zero, money begins to flow again. Right now, we're somewhere in between. Banks are still tightening, but far less than in 2023. Credit isn't healthy enough to boost hiring, but it's not tight enough to force layoffs either. And that may be why companies are holding headcount steady, freezing hiring but not cutting staff. In fact, if we overlay this chart with the unemployment rate, we can clearly see that credit conditions tend to lead unemployment by roughly 2 years. So it's possible that if credit conditions continue easing from here, the unemployment rate could start to level off or even drift lower. And in that case, these early rate cuts may actually work. That would look a lot like 1995. The Fed began cutting rates into a growing economy, exactly like they're doing today. Credit loosened, hiring picked back up, and we saw a genuine soft landing. Back then, that same Fed pivot fueled one of the most aggressive bull markets in history for stocks and risk assets. Ultimately, the takeaway for investors is clear. Keep an eye on credit conditions and the jobs market. That's where the difference between a soft landing and a repeat of past downturns will be decided. At Capital.com, we'll continue tracking these shifts in global monetary policy, the labor market, and the signals they send for markets. Hit like and subscribe to stay tuned. Thanks for watching.